Internet banking, also referred to as online banking or e-banking, allows customers of a financial institution to conduct financial transactions on a secured website operated by that specific institution, which can be a retail bank, virtual bank, or a credit union. Some of the common features that are offered in online banking are viewing account balances, viewing recent transactions, downloading bank statements, viewing images of paid checks, ordering checkbooks, transferring funds, paying bills, and loan applications. Internet banking has been around for just barely over 30 years now. Back in 1983, the Bank of Scotland offered Nottingham Building Society (NBS) customers the first internet banking service in the UK and called it Homelink. Homelink was connected via a television set and a telephone to send transfers and pay bills. Homelink is the service that formed the basis for online banking as we know it today. After internet banking being at a standstill for just over 10 years, Microsoft built online banking into their Microsoft Money personal finance software, letting nearly 100,000 households have access to their bank accounts online. The main focus of Chapter 3 is centered on Michael Porter's 5-Force model. Porter's Forces outlines 5 main things that every manager should consider from a company and industry standpoint. The 5 forces to consider are threat of entry, power of suppliers, power of buyers, threat of substitutes, and rivals among competitors. If the 5 forces are strong, there is less of a potential for industry to be profitable. The threat of entry is determined by the extent of the entry barriers a company will face when they are trying to come into an industry. Entry barriers can be defined as any obstacles a firm must face during the process of entry. When it is hard to enter an industry, the industry profitability will be high. For potential competitors, it is important to pay attention to the height of entry barriers. The power of suppliers consists of the extent of the pressure a supplier can put on a company's, or industry's, profitability. Suppliers can influence the profitability of the company by requiring higher prices or supplying varying levels of quality. Suppliers will be more powerful when substitutes for products are hard to find. If the competition between suppliers is low, the power will be higher, and vice versa. If a buyer requires more products or services at a higher quality, the profit for a company will be higher. When the buyers can influence a company to discount their company, the profit for that company will decrease. There are many factors that will influence the power a buyer has over a company or an overall industry. Threat threat of substitutes refers to companies outside of an industry, but very close to that industry, structuring their products in a way that could potentially be a threat to the industry in question. Substitutes that have a lower, or discounted, price will increase the threat of the customer switching to buying the substitute. The final force of Porter's 5-force model is the rivalry among existing competitors. Rivalry of competitors refers to the intensity in which companies will fight for the highest market share within the industry. The stronger the combination of the previous 4 forces, the more intense the rivalry among competitors in the industry will be. If the industry competition is intense, profitability will tend to be low due to discounted prices, which will cause advertising of products to be costly. Exit barriers, or the ease at which a company can leave the industry, will also influence rivalry. If exit barriers are low, the industry will be more attractive. Internet banking at first faced drawbacks with living up to their anticipated success. Going forwards, most executives have concerns with facing the issue of customers not adopting Internet banking services. The focus of this article is examining how the growth of the Internet has affected the competitive landscape of the banking industry. Research has shown Internet banking will become the trend for the banking industry in the future. As this trend grows, it is becoming more important that banking executives understand the real impact the Internet has on the industry. With Internet growth, small companies have the opportunity to seize advantages and set new competitive goals. Because economies of scale are only relevant in markets where participants play by the same set of rules, the Internet is dissolving economies of scale since physical processes can be replaced by information from the Internet. The laws and regulations in Internet banking are not as defined as traditional banking, reducing the barriers to entering the market. The banking market is likely to see the emergence of new small banks that use the Internet to compete on equal ground with financial giants. The Internet lowers the barriers to entry within the banking industry, making it easier for small banks to emerge. Internet banking increases the bargaining power of buyers. The more products that become standardized, the lower the switching cost, and the more power is yielded to buyers. With the increase in newcomers entering the industry, the alternatives of banking customers increase, resulting in more bargaining power. Banks have previously acted as suppliers. However, in this new Internet banking world, the business model has changed dramatically. Banks are no longer gatekeepers, but gateways to financial products. In the new gateway model, the bank functions as a flexible intermediary that provides access to an entire spectrum of products and delivery channels. Some of the products may not originate from the bank but from a third-party provider. With low barriers to entry, more competitors are entering the industry. The operation costs for internet banking are lower than those of the traditional distribution channels, aiding in the threat of new competitors. The internet enables smaller banks to compete with large-scale banks because the traditional, high-cost traditional branch bank is not mandatory. The actual size of banks is becoming less relevant. The internet eliminates costs involved with customers changing to a new bank. The internet has created the possibility of many substitutes in the banking industry.